Good afternoon, everyone. I hope that everyone had a wonderful long weekend, a fun President's Day. But now that we're back in the saddle, we want to take a quick review here in terms of what's really happened here over the last week, 2 weeks. And what we've seen is we've actually had 3 down weeks in the market. But what we like about this particular pullback is that it's relatively orderly. Now, if we think back last year at this time, those pullbacks were certainly not orderly. They were panicky, they were disruptive, and they were doing a lot of damage. It was really kind of like a wildfire sort of cutting through a portfolio. This time around, we're seeing very controlled pullbacks. And so we're going to go through all in terms of what that means for your portfolio, what that means for the broader market, and how we're navigating the chop. And that's exactly what we're calling this week's update, is navigating the chops. From a seasonal perspective, the back half of February does tend to be a little bit more volatile, a little bit more choppy. Why is that? Because January is a seasonally positive time of the year for the market, right? People get off to the start of the year, a lot of optimism, with the exception of last year, of course. And then February tends to be a bit of a hangover month. It's like, okay, we've digested some of those gains. Now what? What's the next catalyst? And so that's kind of what we're going through right now. So we're going to split this presentation up into 3 different phases. What is the pullback trying to tell us? That's the first thing. Number 2, how does this recovery compare to other recoveries from previous bear market bottoms, assuming that was a bear market bottom back in the fall? And then lastly, searching for clues from Europe. Something is happening in Europe. Something is happening in Japan, but in Europe in particular. And what is that trying to tell us about asset allocation here in the US? So we can see here the X's that you see across the S&P maps, across the S&P chart, are those periods of distribution. And distribution means when you have down days where down stocks outnumber up stocks by a 5-to-1 ratio. That's what we call a distributive day. Now, what's interesting is that in the last 3 weeks, as the market has put 3 down weeks in a row, we haven't seen any internal weakness in the overall market. Breadth has been relatively strong. We haven't had any 5-to-1 down days like you typically get at these peaks in the market. And overall, the market has largely stayed pro-cyclical. We've seen pro-risk in some of those big technology rally days, although we think that part is going to start to fade here pretty quick. So overall, we kind of like this. We like the fact that we're not getting those panicky down days. And then the other thing we want to remind people is that recoveries do take time. March of 2020 was certainly that anomaly, right? Where you had almost a 35% sell-off, and then that recovery period took the better part of 6 or 7 weeks. This is a little bit different. We expect this to be a little bit drawn out. When we look at prior years, when we look at prior recoveries, this has generally been the map in terms of the market recovery after a negative calendar year return. So this is the blue line that we're talking about. Notice what happens in February. You tend to stall out a little bit before you get the next leg upward in March and April. Now, we're not going to try and get that specific. Hey, on March, we think we're going up. In April, we think we're going up. But those tend to be seasonally pretty optimistic times for the market in more normal years. Now, what is this blue line? The blue line are markets where how a market has recovered after a negative calendar year return, but also when the first 5 days of the new calendar year were up more than 1.4%, like they are this year, right? So the first 5 days of this past January, the market went up more than 1.4%. What's interesting is that the return profile is structurally higher than all other negative prior year events. So we think that means in general that the structural optimism that really started the markets off with a bang in January was somewhat of a telling sign, especially when we compare the deep sense of pessimism that is really baked into the market right now for what might be in store for the rest of the year. And so, again, don't hold us to this. This is not the crux of our bullish case for the market this year. but it's an interesting factoid as we look at prior bear market bottoms. Where are we today as it relates to the S&P 500? A few things we do want to know. The market has seen some very marked structural improvement. So what do we mean by that? A healthy bull market within within the neighborhood of a bear market bottom, we like to see a good solid start to the year, right? So when you get the first 5 days that are down markedly, that tends to not really be a great sign, because you got smart money that's positioning portfolios for the calendar year, and they're decidedly negative. We don't want to see that type of action, and we didn't. We got a good solid start to the year. S&P 500 was up greater than 1.4% for the first 5 days of the year, as we discussed on that slide prior. Number two, the 50-day moving average is now above the 200-day moving average. We call that in technical terms a golden cross event. In other words, short-term momentum is starting to pull up long-term momentum for the overall market. And then lastly, we did break above that 200-day moving average for the S&P 500. So those are three key events that we think are positive for returns going forward from a technical perspective. Number two is the fact that on prior bear market rallies, we failed around those levels. The 50-day kind of failed right underneath the 200-day, and every time stocks approached that 200-day moving average, we also saw those roll over. We saw that happen in March of 2022, August of 2022, and then certainly again later in the fall. So all of those times were key failed rallies. This time around, we did break through and punch above the 200-day. What's going to be key is, as the market has been pulling back, how does it settle right above that 4,000 level on the S&P 500? The last thing I'll mention, we are approaching the 50% retracement level from the bear market bottom. That is important. That's a key Fibonacci level in technicals. And when you get that 50% retracement, you tend to hit some congestion. You tend to hit some inventory as people start to unload some stock after they've seen their accounts recover. We think we'll get through that, but that's that tying in right with February, right? That's seasonal weakness. So we think that's a key level here, and it's going to take us probably a week or two to punch up through that. And we hope and we think that March and April provide that seasonal strength to get through those levels. Now, one area we're not as optimistic on is, of course, the leaders of the prior bull market, right? So we're thinking that technology, profitless tech, green tech, those types of areas that really pulled the entire bull market for the last 12 years. Those are areas right now we would be really careful with chasing. We saw a vicious short cover rally in January. We've already started to see selling resume in many of those areas. Now, there's certain stocks like Airbnb and Uber that have put fantastic quarters forth here in the last week or two, and those might be candidates of standalone stories outside of the big picture. But in the bigger picture, these whether it's technology or IPOs or SPACs, we would be really careful at these levels. The short cover rally that we've seen, the easy money off those bottoms, we think has largely been made. And when we look at the long-term charts, we're hitting a lot of resistance levels here. So we would be really, really careful here. The other thing, financial conditions are starting to tighten a little bit. So when this line goes up, it means that financial conditions are getting tighter. When this line comes down, financial conditions are getting easier. This line has started to go up again. What is the one group that has the highest correlation to the financial conditions index? It's technology. So when financial conditions start to ease, technology tends to outperform. When they get tighter, it tends to underperform. We would be watching this chart. We would be watching levels right here. If you've got high technology exposure, you've been given a gift the last 5 or 6 weeks. Personally, if it were me, I would probably be taking a little bit of profits here and getting a little bit conservative in that particular sector. Now, as it relates to the bear market, as it relates to the economy, the biggest consensus call that we've seen, of course, over the last few months has been recession. Now, Bank of America Merrill Lynch put out an incredible chart here over the last week, and I thought it was very telling. So this chart here shows the percent of investors that believe a recession is likely. In November of 2022, just a couple months ago, it reached close to 80%. When are the other two instances over the last 20 years that we've seen that take place? April of 2020 and March of 2009. Those should be familiar dates. Why? Those were key bottoms in the stock market. And so again, peak recession fear does not mean sell stocks. Peak recession fear means, hey, you made it all the way through the pain. Now's the time to be disciplined. Now's the time to be looking for some profit opportunities, in our opinion. And what's one of the big reasons why we're so bullish right now? It's because of what's happening over there in Europe. Europe could not possibly have a more negative macro backdrop in 2022. Not only did you have interest rates skyrocketing in the US, which is the largest economy in the world, you had a war in Eastern Europe between Russia and the Ukraine, the two largest countries on that continent. You had natural gas prices that were the equivalent of $200 in Europe versus right now it's about $2.50 in the US, just to provide that perspective. You had every reason for Europe to sell off, but it hasn't. In fact, the FTSE, and we talked about this a couple of weeks ago, is at an all-time high. I mean, that's incredible. No one's talking about that right now. And that strength is pretty widespread across Europe. So when we look at the German DAX and the French CAC relative to the S&P 500, it's outperforming and has been outperforming throughout 2022 and into 2023. And if we look at these two markets, these are markets that are sitting at 52-week highs. This is what you're seeing here are the charts relative to the S&P 500. Now, here's the other interesting aspect. What are the sectors that are the biggest sectors in those particular markets? It's not technology like it is here in the US. It's materials, industrials, financials. Those are the areas that are the largest in these particular markets. And we think a key reason why these markets are outperforming. Again, that takes us back to our broader call of old economy versus the new economy. We do think that technology is going to continue to come in. Energy, materials, industrials, those leaders that will converge and overtake that technology way through time. We think these stocks are cheap. Earnings continue to improve. They're underowned, maligned, and hated across Wall Street. We think that's an opportunity. So overall, as we navigate this chop, it's important to not chase areas here for a day or two. This particular week, or last week in particular, we saw one day was completely different than the next day, and that happened every single day of the week. Stay true to the big picture, stay focused. Europe remains an area of leadership, which to us means old economy over the new economy. And we do actually continue to think energy is pretty well set up here as global consumption rebounds. So any questions, 888-543-3776. Hope everyone, again, has had a great long weekend, great start to your week, and we're here to help. Thank you.